You know, there's a rhythm to the market, a kind of music that only a trader who listens long enough can hear. Most people never do. They charge in at any hour, buy or sell because the screen flashes a certain way, and then wonder why they keep losing. But if you've been following my work, you already know better. In the previous video on entry trick to boost win rate, we talked about how the timing of your entry can shift the odds just a bit in your favor. Today, we're going to talk about when the market sings its clearest tune, the best time of day to trade for maximum profits. Now, don't mistake what I'm saying. The market doesn't hand out money by the clock. It doesn't open at 9:30 and say, "Here's your fortune, my friend." No, the market is a living thing. It wakes up, stretches, and starts to reveal its mood little by little. That first hour, that's when you can really feel its heartbeat. Ever noticed how the opening feels like a storm? The overnight orders, the nervous crowd, the traders who can't stand to wait, all of them pour into those first 60 minutes. It's fast, it's loud, and it's full of traps. So, I ask you, do you rush in with them, or do you wait for the dust to settle? I learned early in my career that the first move of the day is often a feint. The amateurs push prices one way, and the professionals quietly take the other side. If you want to trade like a pro, you don't join the noise, you read it. Watch the tape. Watch how prices behave after the initial push. Is volume confirming the direction? Are the leaders moving with conviction, or are they hesitating? When you train your eyes to see that, you'll find your moment. Not when everyone else is excited, but when the market itself is revealing its hand. Now, I can almost hear you thinking, "Jesse, are you saying the opening hour isn't worth trading?" Not at all. The opening can give you your best opportunities if you understand what kind of trader you are. The scalper loves the open because volatility is his playground. The position trader might prefer the quiet mid-morning when false moves fade and real trends begin. So, ask yourself, what kind of trader are you? You can't fight your own temperament and win. You see, trading is not about predicting. It's about waiting for confirmation. The best time to trade isn't fixed. It's when your setup, your signal, and your temperament all line up. And that alignment, more often than not, comes a few minutes after the open, when the noise starts to thin. Around 10 o'clock, the market has shown its first card. By then, you can see who's trapped and who's in control. That's when the smart trader takes his position. That's when the probabilities begin to favor patience over excitement. But here's the catch. Most traders can't wait. They want action. They want the thrill. They want to make something happen instead of letting the market tell them what's happening. Ever felt that urge yourself? That little voice saying, "You'll miss it if you don't act now." That voice is what separates the gambler from the operator. A trader earns his profits not by trading often, but by trading well, timed moves. The clock doesn't control him. His discipline does. The middle of the day is another story. Between 11 and 2, the market goes to sleep. The professionals step back. The crowd grows impatient. Volume fades, and what's left is a slow drift designed to lure you into boredom trades. Don't fall for it. I've seen more traders lose in those lazy hours than during any violent morning swing. If the morning is the storm, then midday is the lull, and if you don't recognize it, you'll mistake silence for opportunity. Now, remember what we talked about in that video on entry trick to boost win rate, how a perfect entry isn't just about price, but timing within the setup. That same principle lives here too. You can have the best pattern in the world, but if you take it during a dead hour, it's like planting seeds in frozen ground. Timing makes the difference between a trade that moves immediately in your favor and one that dies slowly while you sit there second, guessing your plan. By the afternoon, the rhythm changes again. Around 2 o'clock, the big money starts positioning for the close. You'll see life come back into the charts, volume start to tick up, momentum quietly shifting. The last hour is where you'll see reversals confirmed or faked, where the real move of the day reveals itself. But here's where many traders go wrong. They chase the closing action like they chased the open. They forget that the market is always one step ahead. If you miss the move, Don't chase it. The market will always open again tomorrow. It's not about how many trades you take, it's about how many good ones you wait for. Trading, my friend, is a waiting game disguised as an action game. The best time of day to trade isn't when the clock says so, it's when the market agrees with your plan. The open, the midday, the close, they each have their own character. Your job is to know which of them speaks your language. Some traders make their living in the first 30 minutes. Others sit quiet all morning and strike only once in the afternoon. The difference isn't luck, it's understanding. And that understanding starts with observation. Spend a few days just watching the market. Don't trade. Watch how the price behaves at 9:30, 10:30, noon and 3. Feel the pace, the energy, the rhythm. The market talks, but it doesn't use words, it uses behavior. Can you read it? Because once you can, you'll stop forcing trades and start finding them. It's not glamorous, I know. Patience doesn't sell as fast as excitement. But every great operator I ever met learned that timing, real timing, isn't just a clock on the wall. It's the patience to wait for the hour when the odds tilt quietly in your favor. When you master that, you don't need to trade all day. One good trade, taken at the right time, is worth a dozen taken at random. Think about that the next time you're tempted to jump into a move just because the screen lights up. The market, my friend, isn't a machine. It's a living organism with moods, tempers, and rhythms that shift as the day unfolds. Most traders don't see that. They treat the market like a static thing, the same at 9:30 as it is at 3:30. But if you've watched the tape long enough, you know that's not true. The market breathes. It wakes up, it tires, it gathers strength, and it rests. Each part of the day has its own personality. And if you're going to survive, let alone profit, you've got to learn to trade in sync with that rhythm instead of fighting it. I used to think the market was only about price levels, support, resistance, trend lines. But price is just one part of the story. Time of day is the other half. It tells you how the market is likely to behave, who's active, and what kind of emotion is driving the flow. The open, the midday lull, and the close, they each carry their own kind of energy. Think of them as different acts in the same play. The script changes, the actors change, and the mood changes too. You wouldn't deliver the same line in the same tone in every scene, would you? Then why trade the same way all day? Take the opening bell. That's the market's morning rush, the surge of orders accumulated overnight, the release of pent-up emotion from traders who couldn't sleep. The amateurs pile in first, chasing headlines, reacting to pre-market gaps, buying because they're afraid to miss the move. The pros, meanwhile, are watching quietly. They're studying how the market reacts to that first wave, whether it absorbs the pressure or gets overwhelmed by it. The open is a test of conviction, not a guarantee of direction. So the first lesson in understanding the market's mood is learning that morning energy doesn't always tell you the truth. Sometimes it's real strength, sometimes it's a bluff. The job of a trader is to read the difference. Then, as the clock moves past 10 o'clock, you can almost feel the tempo change. The crowd has spent its energy. The noise begins to fade. If you look closely, you'll see the market settle into a more deliberate rhythm. The false breakouts fade away, the real moves begin to take shape. This is when the professional steps in. He's been waiting for that first rush to burn out, waiting for the dust to clear. You might call it patience. I call it professionalism. The trader who understands time knows that every market has its heartbeat, and he waits for the rhythm that matches his own. Ever notice how between 11 and 1, everything seems to slow down? That's not your imagination. It's the market's nap. The big money is at lunch, the news flow dries up and liquidity thins. Prices drift aimlessly, teasing traders into thinking they see opportunity where there's only indecision. If you don't understand that this is just the market's quiet hour, you'll mistake stillness for stability. You'll enter trades that go nowhere, only to find yourself trapped when the afternoon brings volume back. That's the danger of ignoring the market's mood. You start trading the clock instead of the conditions. By the time the afternoon session begins, a new mood takes hold. The professionals return, the algorithms pick up speed, and the market prepares for the close. This is when you start to see whether the morning trend holds or reverses. If the market has been strong all day but volume starts drying up, it's a sign of fatigue. If it's been weak but suddenly attracts fresh buying near the close, you might be seeing smart money accumulating positions for the next day. You can feel it in the tape. The urgency, the quiet aggression, the sense that something is being set up. Now, think about what this means for your trading. If the market has moods, and you trade without recognizing them, you're blind. You're stepping into different weather conditions without checking the sky. Would you wear the same clothes for a storm and for sunshine? Of course not. Then why trade the same way at every hour? There's a time to attack and a time to wait. A time for precision and a time for patience. The trader who learns this rhythm doesn't just react. He flows with the market. Let me tell you something I learned the hard way. When I was young, I'd trade every minute the market was open. I thought activity was proof of dedication, but all it proved was impatience. The truth is, there are only a few good windows in a day when the probabilities are stacked in your favor. Those windows aren't hidden. They reveal themselves in the rhythm. The market tells you when it's alive, when it's asleep, when it's waking up again. The trader who listens can catch that pulse and ride it. The one who doesn't will always be a step behind. You might be thinking, Jesse, how do I actually sense that rhythm? Observation, plain and simple. Sit and watch the market without trading. Watch how it behaves at different hours, how volume moves, how spreads widen or tighten, how certain stocks lead in the morning and others lead in the afternoon. That's the education most traders skip. They want systems, not awareness. But awareness, true observation, is what makes a trader alive to the market's moods. Every professional knows that price patterns mean nothing without context, and time provides that context. A breakout that happens at 10 in the morning means one thing, the same breakout at 2:30 means another. You have to ask yourself, who's acting at this hour? If it's the emotional morning crowd, maybe you fade it. If it's the institutional close, maybe you join it. The tape looks different depending on the hour because the hands moving it are different. Midday trading, that quiet stretch between 11 and 2, has fooled more traders than the most volatile open. It looks peaceful, even inviting, but it's a mirage. You see the candles flattening out, volume drying up, price barely moving, and something inside you says, here's my chance. The market's calm, it's safe. But the truth is that stillness isn't safety. It's a trap. The midday hours are the market's rest period, the time when the professionals step aside, the big orders pause, and what's left on the field are the restless traders who can't sit still. Ever found yourself clicking buy or sell just to feel like you're doing something? That's the midday illusion at work. The market is a living thing, and even it needs to breathe. After the chaos of the morning session, where emotions explode and direction is established, comes the lull. It's not random. The energy spent in the first few hours takes time to recharge. By late morning, the players who matter, the institutions, the funds, the seasoned operators, have already made their moves or are waiting for confirmation. What's left is a landscape of low volume and false comfort. Prices drift sideways not because the market is balanced, but because it's waiting. Waiting for new information, waiting for a reason to move again. When the tape slows down, traders lose patience. That's when mistakes happen. They start forcing trades in what I call boredom zones. A setup that looked mediocre in the morning suddenly looks appealing just because the trader wants action. But the market doesn't reward impatience, it punishes it. Every experienced operator knows that during these hours, liquidity thins, spreads widen, and stops get triggered by nothing more than random noise. You think you're catching a breakout, but it's not a breakout. It's a hiccup. I've seen countless traders fall into this trap. They think, well, if the morning rush was too volatile for me, maybe midday is calmer, maybe I can catch an easy move here. But there are no easy moves. A market without energy is a market without clarity. You can't surf when there's no wave, the rhythm that drives profitable moves, the participation, the conviction, is missing during these hours. So when you find yourself staring at the screen around lunchtime, ask yourself, is the market offering me something, or am I trying to take something from it? There's a reason professionals often step away around this time. They understand that silence isn't opportunity, it's preparation. They use those hours to review their morning trades, study the charts, plan for the afternoon, and, most importantly, stay out of trouble. That's the mindset difference between the novice and the professional. The novice wants to do something, the professional waits for something worth doing. One is chasing the market, the other is in sync with it. Now, you might argue, but Jesse, sometimes moves do start during midday. Shouldn't I be ready? Of course, you should always be ready, but readiness doesn't mean restlessness. The key is to recognize whether that move is genuine or a fake. Real moves during midday are rare, and when they happen, they're usually quiet beginnings of something larger, a slow accumulation, a base forming before the afternoon breakout. You'll see volume building gradually, not erratically. The tape will tighten, not thrash. That's the kind of action worth watching. But you'll only notice it if you're patient enough not to be in a dozen meaningless trades at the same time. Do you remember what I said in that earlier video on entry trick to boost win rate? Timing your entry matters more than predicting direction. The same rule applies here. Entering during the midday lull is like planting in dry soil. Even if your analysis is right, the market may not have the strength to carry your trade forward. It just sits there, lifeless, until a sudden afternoon burst stops you out before the real move even begins. When traders complain that their setups don't work anymore, often it's not the setup, it's the timing. They're trading a good idea at a dead hour. You have to understand the psychology behind the midday trap. The human mind craves rhythm and resolution. After the morning adrenaline fades, that quiet space feels unnatural. The trader's brain looks for stimulation. That's when false signals become convincing. A small uptick feels like a breakout, a tiny dip feels like a reversal. The screen whispers, do something. But you have to remind yourself that no signal means no trade. The best operators know when not to play. It's not cowardice, it's capital preservation. If you sit through enough days, you'll start to feel it. The energy of the morning fades around 11. The chart flattens, volume bars shrink, price wobbles inside tight ranges. That's the market telling you to wait. Around 1:30, you'll notice it slowly coming back to life. Volume starts ticking up again, small bursts of direction appear, and the tape starts to breathe. That's when the preparation you did during the lull pays off. While others were burning capital on meaningless midday trades, you were conserving yours for the hours when it matters. I remember one trader, years ago, who couldn't stand the quiet. Every day, he'd complain, there's nothing moving. But instead of waiting, he'd start shorting or buying random names, convinced he'd find something the market was hiding. By the close, he'd be exhausted and down for the day. I told him, you're trying to force profit out of stillness. The market doesn't pay for effort, it pays for timing. He didn't like that answer, but he learned it the hard way. Midday trading teaches patience better than any other part of the day. It's when your discipline is tested. Anyone can trade when the market is screaming. Few can sit still when it's whispering. If you learn to respect those hours, not fear them, not chase them, but understand them, you'll find that your overall trading improves. You'll take fewer bad trades, you'll save energy for the right ones, and your edge will sharpen. The midday lull isn't your enemy, it's your teacher. It tells you to slow down, to wait for confirmation, to plan instead of react. It separates the impulsive from the intelligent. Every trader who's lasted long enough learns this lesson one way or another. The market gives you clues, and one of the clearest is this: when it gets quiet, it's not inviting you in. It's asking you to listen. The last hour of the trading day is a stage where the real players step out from behind the curtain. All day long, the market has been whispering clues, testing strength, and shaking out the impatient. But as the clock moves toward the close, something shifts. Volume begins to build, volatility creeps back in, and the character of the market changes. You can feel it in the tape. The hesitation of the midday hours fades away, replaced by intention. This is when the big money moves. The institutions, the funds, the traders with size, they start positioning for tomorrow, squaring accounts, managing exposure, and sometimes setting traps for the unaware. If you've been watching carefully throughout the day, the final hour can reveal everything you need to know about the real direction of the market. It's not about prediction, it's about confirmation. When a stock has been strong all morning and continues to attract volume into the close, that's conviction. When a rally fades sharply in the last hour, that's exhaustion. The close shows you who's in control. Are the buyers confident enough to hold into the next session? Or are they unloading before the bell? Are the sellers pressing their advantage, or are they covering positions to avoid overnight risk? The tape tells you the truth if you know how to listen. Now, you might ask yourself, why does this hour matter so much? Because the close isn't just another point in time. It's a statement. It's where the market leaves its signature for the day. Prices recorded at the close influence portfolio valuations, fund reports, and margin requirements. The professionals know this. That's why they act decisively. The amateurs, meanwhile, are often reacting to what they see rather than understanding what it means. They chase the last bit of movement, hoping to squeeze out quick profits, while the professionals are thinking one step ahead, setting the tone for tomorrow's open. I've always said that the market's mood in the final hour reflects its true strength. A strong market finishes strong. A weak one limps to the line. The close shows you whether the earlier moves were real or simply noise. That's why many of my best trades were built around observing how the market behaved near the end of the day. Not trading every close, but studying it. Because the close reveals the truth of what happened earlier. The morning rush, the midday drift. They all make sense when you see how the day finishes. Do you remember in that earlier video on entry trick to boost win rate, how we talked about letting the market confirm your entry instead of trying to outsmart it? The same principle applies here. The last hour is confirmation time. It's where setups mature or fail, where breakout attempts either hold or crumble. A trader who's patient enough to wait until the close for confirmation often avoids the traps that catch those who trade too early. You don't have to trade the close itself, but you have to read it. It tells you whether the setup you've been watching all day is worth carrying forward or better left alone. The close is also a mirror for trader psychology. Think about it. Every decision made during the day comes to resolution here. The anxious day trader wants to flatten positions before the bell. The swing trader is deciding whether to carry overnight. The institutional fund manager must align his portfolio with end-of-day valuations. All those decisions converge into one final burst of activity. It's not random, it's purpose. And that purpose creates opportunity for those who can read between the lines. You can often see something special happen around 3:30. The volume begins to surge again. Stocks that looked sleepy all afternoon suddenly come to life. Sometimes it's a genuine continuation. Other times, it's a trap. If you're patient and observant, you'll notice that the tone of the market gives it away. In a strong market, the afternoon surge feels natural. Pullbacks get bought quickly, breakouts sustain. In a weak one, every rally into the close gets sold off fast. The behavior of that final hour isn't about luck, it's about pressure. The market is showing you where the smart money wants to be positioned when the lights go out. Many traders make the mistake of thinking the last hour is too risky to trade. It's fast, emotional, and decisive. And yes, it can be unforgiving if you're unprepared. But it's also where the cleanest moves form, because by then, most of the noise has burned off. The fake breakouts from the morning have failed. The sideways drift of the midday has exhausted the impatient, and what remains are players who mean business. When a stock moves into the close with strength and volume, it's not a guess, it's confirmation. The tape is telling you that buyers are willing to hold risk overnight. That kind of conviction can carry momentum into the next session. But don't confuse conviction with urgency. Just because volume is high doesn't mean it's time to chase. If you didn't plan the trade earlier, it's often better to study the close rather than jump into it. The close gives you the information you'll use for tomorrow's plan. It tells you which sectors are leading, which stocks are attracting institutional flow, which setups are showing resilience. When the market shuts down for the day, that's when you start preparing, not when you start hoping. The rhythm of the day begins fast, slows down, and then accelerates again into the close. It's like the tide, rushing in, receding, and returning with force. The professional trader doesn't fight that rhythm, he uses it. The last hour is when the tide comes back. If you've spent the day observing patiently, this is your moment to understand whether the current is shifting with you or against you. Every candle, every tick, every volume surge tells a story. I've seen traders who built entire strategies around this hour alone. They'd spend the morning waiting, the midday studying, and then trade the final 60 minutes with precision, because that's when inefficiency becomes visible. The market, by then, has shown its hand. The false moves are gone, and the direction, whether up or down, has weight behind it. But that approach takes discipline. You have to resist the urge to trade just because you're watching movement. The key is not to trade the noise, but to read the intention behind the noise. When you learn to study the last hour this way, you'll start noticing patterns that most traders miss. You'll see accumulation that's invisible during the quiet hours. You'll see distribution disguised as late day rallies. You'll see where the market wants to go before it opens again. The close is the market's diary. It records the truth of everything that came before it. To the untrained eye, it's chaos. To the trained observer, it's revelation. Patience in timing entries is one of the hardest lessons in trading because it runs against human nature. Every trader wants to act, to do something, to be in the market. The screen moves, the quotes flash, and suddenly the urge to participate becomes stronger than the discipline to wait. But the market doesn't reward action. It rewards precision. The difference between the trader who profits and the trader who loses is often not intelligence or even knowledge, but patience. Waiting for the right moment to act, instead of acting just to feel involved, is where profitability begins. You can study every pattern, memorize every setup, and understand every indicator, but if you don't have the patience to wait for your signal to appear clearly, all that knowledge means nothing. The market has a rhythm, a tempo, and your entries must align with it. When you force a trade, you're stepping off beat. The best entries feel effortless because they come when price, time, and sentiment align naturally. There's no hesitation, no rush, just confirmation. Most traders never get there because they mistake movement for opportunity. But movement without structure is chaos. Patience is what allows you to tell the difference. When I first started trading, I wanted action every hour. I believed the more trades I took, the more chances I had to win. But what I learned, painfully, was that more trades don't mean more profits, just more risk. The market will always offer you something to chase. It takes discipline to realize that most of those offerings are traps. Think about it. How many times have you entered a position just a little too early, only to watch the market move against you before your setup even developed? You weren't wrong about direction. You were wrong about timing. The idea was right, but the patience was missing. Trading isn't about predicting, it's about aligning. You align yourself with the market's flow, and that alignment often takes time to appear. If your setup calls for confirmation from volume, let it come. If you're waiting for a breakout above a key level, let the market prove it. The impatient trader jumps in at the first sign of movement, convinced he'll catch the early part of the trend. The patient trader waits for confirmation and catches the right part of the trend. One's chasing potential, the other's trading probability. And probability, not potential, pays the bills. You ever notice how the best trades seem to move in your favor almost immediately? That's not luck, that's timing. When you enter too early, you spend half the trade hoping it will turn around. When you enter too late, you're chasing. But when you wait for your conditions to align, the market does the heavy lifting for you. That moment of clarity only appears when you have the patience to let the noise fade. You can't see through turbulence. You have to wait for the air to clear. Patience also protects you from emotional exhaustion. Every unnecessary trade drains mental energy. You might not notice it at first, but it builds up. The frustration of small losses, the fatigue of constant monitoring, it all adds up until your judgment starts to slip. Then one bad decision follows another, and before long, your confidence erodes. But when you train yourself to wait, to sit out the choppy hours, to skip setups that don't meet your rules, you conserve that energy. You stay sharp for the trades that truly matter. The market punishes impatience quietly. It doesn't always take your capital right away. Sometimes it takes your focus. You start doubting your system, tweaking your strategy, and chasing the next signal because you can't stand the silence. That's when you drift away from your edge. The patient trader, on the other hand, uses that silence. He studies. He observes. He lets the market show him its hand before committing. And when the time comes to act, he acts decisively. Not because he's guessing, but because he's seen enough to know.